Do you ever feel like financial success is just for a lucky few? Or maybe that the whole world of money is just way too complex to really navigate?
Yeah, it can definitely feel that way sometimes.
Perhaps you're just starting out on your financial journey and you're feeling a bit, I don't know, overwhelmed, not quite sure where to even begin.
That's super common. Totally normal.
Well, you've landed in the perfect place. Welcome to Book Talk Finance.
Glad you could join us.
Today, we're diving into a really practical, insightful book talk. We're looking at the essential building blocks, the personal finance basics.
Yeah, we're going to try and be your guides, sort of cut through all the jargon and the noise.
Exactly. Help you understand what truly matters for your financial well-being. Think of this as like your shortcut to feeling genuinely well-informed.
With lots of practical advice, maybe some surprising facts along the way.
And hopefully just enough humor to keep you hooked. Our mission today is really to demystify everything from, budgeting and saving to getting rid of debt and even the foundational ideas behind investing. Yeah, we want to make sure you walk away with a clear, easy to understand roadmap for your finances.
Okay, let's unpack this then. Before we even get into the practical stuff, the spreadsheets or the different account types, what's often the single biggest hurdle? The thing people face when they first try to get their money in order? Is it just not knowing enough, or is it like something deeper?
Oh, it's almost always something deeper. Yeah. What often gets overlooked but is absolutely foundational is our mindset.
Mindset, okay.
Yeah, the biggest hurdle we face isn't usually a lack of information. It's more about these deeply ingrained beliefs we have and the societal conditioning around what wealth actually looks like.
Right. We're sort of constantly shown this picture, aren't we?
It's
That confuses having a high income with being truly wealthy.
That's it, exactly.
I think I know what you mean there. We automatically see someone with a big salary.
Yeah.
Maybe it's a surgeon, a CEO, a pro athlete, or, a movie star. And our immediate thought is, wow, they must be rich.
Yep, that's the default assumption. It just feels like this natural connection, doesn't it? High income equals wealth. Is that what you're getting at?
Precisely. That's the societal conditioning working on us. We're taught pretty much from day one to equate a high income with being rich. But the crucial distinction, and this is where that mindset shift really has to happen, is understanding that income is just what flows in.
Okay.
While net worth is what you actually accumulate and own over time, what you keep.
Ah, okay. Income versus net worth.
Exactly. You could have a, dazzlingly high income, 6 figures, 7 figures even, but if you spend every single dollar that comes in, or maybe even more, your net worth could be basically zero, or even negative if you're taking on debt.
Right.
Conversely, someone with a much more modest income can build substantial wealth. It's all about disciplined accumulation.
So it's not just about how much you make, but how much you keep and grow.
That's the core of it.
Ah.
Think about this incredible example from the source material. A Vanguard shareholder who, back in 2005, had built up a portfolio worth $1.25 million.
Wow, $1.25 million.
Yeah, and get this, they apparently never earned more than $25,000 in any single year of their life.
Wait, seriously? On $25K a year, how is that even possible? That really challenges everything you think you know.
It really does, doesn't it? And it wasn't some kind of financial magic trick or anything. It's just a powerful illustration that consistent accumulation, not just high earning, is the real path to building wealth.
That makes you rethink everything. So how do we even begin to grasp that? How do we visualize this shift, from just earning a paycheck to actually building net worth?
It really requires this fundamental shift, moving away from what we could call a paycheck mentality.
Right, living paycheck to paycheck.
And moving towards a net worth mentality.
Yeah.
And to make this concept really land, think about the parallels between how many people approach money and how they approach food.
Food. Okay, interesting analogy. How so?
It's remarkably similar, actually, and often just as irrational. Think about it. Now, many of us don't track our calorie intake very easily.
Guilty as charged, yeah.
And as a result, we probably eat more than we realize. Similar, we often don't track our spending, so we spend more than we realize, or maybe more than we'd even care to admit.
Okay, I see the parallel. Ignoring the details.
Exactly. And when it comes to health, maybe we debate the tiny details of different diets or the absolute perfect workout routine.
Yeah, analysis paralysis.
But then we struggle to actually take consistent action. It's the same in finance. We'll debate interest rates or chase the latest hot stock tip without taking that meaningful, disciplined action day in and day out. And when it comes to advice, think about who people listen to. Often it's anecdotal tips from friends or family or something they saw on social media.
Right, instead of maybe digging into researched information.
Exactly. Instead of looking at thoroughly researched, time-tested information from, solid financial literature. In both areas, health and finance, these approaches often lead to the same frustrating result. Very little actual progress.
That's a really powerful comparison. Awareness and consistent action beat endless debate without actually doing anything.
That's the key takeaway. Awareness and consistent action, even small actions, they just far outweigh endless analysis if you never execute.
So that food and money analogy is really insightful. It highlights how we get bogged down in details and ignore the basics. But you also mentioned a deeper, almost philosophical view of money. Tell us more about this idea of money as life energy.
Yeah, this is where things can get really transformative for people. At its most fundamental level, money isn't just currency, right? It's not just numbers on a screen or paper in your wallet.
Okay.
It represents your life energy. It represents the precious time and the effort you exchange for it. Every dollar you earn costs you a certain amount of your finite life.
Wow, framing it like that. Life energy. That's intense.
It is, and when you really start to reflect on this, you begin to see how making a living can sometimes feel more like making a dying.
Oof. Yeah.
If your job constantly demands sacrifices that, erode your health or strain your relationships or just extinguish your sense of joy and purpose, you're trading your life energy for something that might be depleting you.
So many people feel trapped in that cycle.
Exactly. Many people find themselves sacrificing their very lives for money, just slowly, almost without noticing until decades have passed. And then they wonder, where did all that time go?
Yeah.
So the ultimate goal of financial independence, when viewed through this lens, is to liberate yourself, to free yourself from needing to work for money entirely.
Or at least have the choice.
Or at the very least, to reach a point where if you do work, it's completely by choice, driven by passion or purpose, not just financial necessity.
That sounds like true freedom.
It really is.
Yeah.
And tracking your money flow, seen this way, it isn't about judging yourself for feeling deprived. It's about gaining this profound awareness, understanding how much of your irreplaceable life energy is truly passing through your hands.
And asking if that trade-off is worth it.
Exactly. Asking, does that exchange truly align with my deeper values, with my aspirations for my life?
So if money is our life energy, how do we start spotting where we might be leaking that energy, wasting it, maybe without even noticing? What's a common energy leak people often overlook?
Oh, a huge one is just unconscious spending, where money just sort of flows out without much thought or real intention behind it.
Like autopilot spending.
Yeah, exactly. Think about subscriptions you signed up for and don't really use anymore, or those impulse buys that give you a quick hit of satisfaction but then just clutter up your house.
Uh-huh. We've all been there.
Or even just habitual spending, like the daily coffee or lunches out, things that don't truly add significant value or joy to your life when you really examine them.
So tracking helps bring those to light.
Absolutely. The simple act of tracking, even just for a month or two, it illuminates these leaks like nothing else. When you physically see where your life energy, your money is actually going, then you can consciously choose to redirect it.
Towards things that matter more.
Towards things that bring you genuine joy or more freedom or help build that future security. It's all about optimizing that precious exchange of your life energy.
That makes so much sense. Being intentional with your time and energy, not just letting it sort of dissipate. But, okay, for many people, the whole world of finance just feels incredibly complicated, Full of jargon, endless choices, complex strategies.
Yeah, intimidating.
Totally. What's the real truth about simplicity and consistency in this seemingly overwhelming world? Is it really that complex?
That's such an important question. Why does finance often seem so complicated? And the simple, maybe slightly controversial truth is that investing at its core isn't actually inherently complex.
Really? It certainly feels like it sometimes.
I know. But often, that perceived complexity serves a purpose, and it often benefits those who are selling financial products or services more than it benefits you, the investor.
Ah, okay. Complexity sells.
Complexity sells. They profit from making you believe you need their intricate strategies or their special secret sauce to succeed. But true financial success, the kind that actually lasts and is genuinely accessible to everyone, it often comes from applying what we might call eternal laws of nature.
Okay, eternal laws of nature. What does that mean in finance?
It means principles that are actually quite straightforward, universally available. They just require maybe a bit of faith and courage to consistently apply them over time. It isn't magic, it really is common sense.
So like basic principles applied consistently.
Exactly. Consistent, disciplined effort over the long term. Making small, smart moves repeatedly. That almost always outperforms trying to use complex short-term strategies to beat the market or predict the future.
It's about sticking to a sound plan.
Sticking to a sound, simple plan and just letting the incredible exponential power of compounding do its heavy lifting over time.
And sticking to that plan, especially when, the market gets rocky or life throws you a curveball, that means facing our fears, right? And inevitably learning from mistakes. What's the advice on navigating that essential, often uncomfortable part of the journey?
You're spot on. If you take action, particularly in an area like finance where there's always some inherent uncertainty, you will make mistakes. It's pretty much guaranteed.
Okay, good to know. Expect mistakes.
Expect mistakes. But what's crucial to understand is that it's from our mistakes that we learn the most valuable lessons. Think about it. Anything truly important in life, anything that leads to real deep wisdom, it can't really be learned just sitting in a classroom.
True. Experience is the best teacher.
It has to be learned by doing, by taking action, experiencing the consequences, making those mistakes, and then consciously correcting them. That's when genuine wisdom starts to set in.
So don't be paralyzed by the fear of making a mistake.
Exactly. Courage, in this context, isn't about not feeling fear. It's about the willingness to act despite the fear. Think about entrepreneurs, successful ones. Recognize fear, they acknowledge it, but then they deal with it directly and move forward anyway.
That's a great mindset shift right there. Acting despite fear.
Yeah. And it's also really vital to acknowledge another significant psychological challenge. This one often comes up later in the financial journey.
Oh, what's that?
It's the shift from a deeply ingrained savings mode to a spending mode, or what financial planners call decumulation.
Ah, spending the money you've saved. That sounds like the fun part.
You'd think so. But most of us spend our entire working lives perfecting the habit of saving,
Yeah.
of accumulating, of deferring gratification. That becomes deeply wired.
Right. You train yourself for decades to save, save, save.
Exactly. Then suddenly, when you reach financial independence or retirement, you're told to do the complete opposite. Start spending down those assets you worked so hard to build.
I can see how that would feel.
Yeah.
Weird. Maybe even scary.
It can be incredibly difficult psychologically because those old habits, even good habits like saving diligently, they can be incredibly hard to break. It requires a conscious effort to retrain your brain, to see spending from your accumulated wealth not as a drain or something irresponsible.
But as the whole point of saving in the first place?
Precisely, as the fulfillment of a lifelong plan. Some people genuinely feel guilt about spending or this constant fear of running out, even when the numbers clearly show they have more than enough.
Wow. It really shows how deep our financial psychology runs.
It's a testament to how deeply rooted our financial behaviors are. It's not just about the numbers.
Okay, that whole discussion about mindset, the psychology, even the challenges of spending later on, that really sets the stage perfectly. So let's say we're ready. We want to move from that paycheck mentality to a net worth mentality. We understand money as life energy. Where do we actually start with the practical nuts and bolts steps? What's the very first move for someone looking to really get their finances in order?
Right, the absolute foundational principle, the golden rule, really, of personal finance that has just stood the test of time is incredibly simple. Pay yourself first.
Pay yourself first. Okay, heard that before. What does it mean in practice?
It means you must automatically set aside a portion of your earnings before you do anything else with that money, before you pay any bills, before you buy groceries, before you spend on entertainment, anything else. That money comes off the top for you.
So savings isn't what's left over at the end of the month.
Absolutely not. If you wait for the leftovers, there often won't be any. This isn't some newfangled idea either. It aligns with ancient wisdom. It's famously highlighted in The Richest Man in Babylon, which advises putting aside no less than 1/10, 10% of your earnings to build an estate for your future, to build wealth for yourself.
Okay, 10% as a starting point. Sounds simple in theory, but I can imagine listeners thinking, how do I actually stick to that, especially if my bills already feel tight? And does it really work if you can only start small?
It is incredibly effective, precisely because it's so simple. And its true power gets unleashed when you automate it, completely automate it.
Automation. Okay, how?
This is where the set it and forget it method becomes your absolute best friend. Have the funds automatically deducted from your paycheck, or automatically transferred from your checking account on payday and deposited directly into your separate savings or investment accounts.
Ah, so you don't even see it or have to think about it?
Exactly. It removes that decision-making friction. It removes the temptation to spend it. It just happens consistently in the background. Think about the McIntyres, mentioned in our sources. They started out saving a pretty modest 4% of their income.
Okay, 4%. That feels more manageable.
Right. And then, over time, as they got raises or adjusted their spending, they gradually increased that percentage up to 15%. They averaged around 10% consistently over their working lives. And this seemingly small but totally consistent action allowed them to build significant wealth.
So consistency is key, even if the amount starts small.
Consistency is everything. And just to give you a really concrete, almost mind-blowing idea of the power of small, consistent savings. Saving as little as, say, $5 to $10 a day.
Like the cost of a fancy coffee or a lunch.
Exactly. That small amount, thanks to the power of compounding returns over time, can grow to over $1.3 million in 30 years.
$1 million from $5 a day.
And nearly $3.8 million in 40 years.
It sounds unbelievable, but the math works if you have time and consistent returns. When you think about the average person working maybe 90,000 hours in their lifetime.
Wow, that's a lot of hours.
Dedicating just 1 hour of your daily work towards yourself through consistent saving is an incredibly powerful lever for your future. You're literally working for your own freedom down the road. Wow. Framing it as working 1 hour a day for yourself, those numbers are truly eye-opening. It definitely makes you think differently about where your life energy is going. But okay, for many people, the word budgeting itself, it just feels restrictive, doesn't it? Like a financial straitjacket. It can be really discouraging. Is there a more positive, maybe more sustainable way to manage day-to-day spending?
There absolutely is.
Yeah.
And you're right, budgeting has negative connotations for a lot of people. It evokes feelings of deprivation, limits, things you can't do.
Yeah, exactly. Punishment.
So instead of that traditional, often restrictive budgeting, we advocate for something called a conscious spending plan.
Conscious spending plan. Okay, I like the sound of that better already. How does it work?
The goal here isn't to restrict your life. It's actually the opposite. It's to consciously decide where your money goes, aligning it with your values.
Yeah.
And ironically, making these proactive decisions actually removes the guilt from spending.
Removes the guilt.
Because you've already allocated specific funds for enjoyment. You know, you've covered your savings, your investments, your bills. So the money left over for fun is genuinely guilt-free.
Okay, I'm intrigued. How do you structure it?
It typically involves dividing your take-home pay, the money you actually receive after taxes, into 4 main categories. It provides a flexible framework. You allocate roughly 50–60% for your fixed costs.
Rent, mortgage, utilities, car payments, debt.
That's exactly the must-pays. Then, crucially, 10% goes straight to investment stocks. Investments, maybe your 401k, your Roth IRA. That's your pay-yourself-first investment piece.
Got it. Fixed costs, investments. What else?
Then you allocate maybe 5–10% for specific savings goals. This is different from long-term investing. This is for things like saving for a dream vacation, holiday gifts, a down payment on a house, or boosting your emergency fund.
Okay, short to medium-term goals.
Right. And finally, that leaves a generous 20–35% for guilt-free spending. This is for dining out, entertainment, clothes, hobbies, whatever brings you joy in the present.
20 to 35%. That sounds like a lot more fun than most budgets allow.
It is. Because the plan acknowledges that enjoying life now is also important. You've consciously decided where your money goes, so there's no reason to feel guilty about spending the portion you've allocated for enjoyment.
I really appreciate that emphasis on guilt-free spending. It definitely sounds much more sustainable and, frankly, enjoyable than the punitive feeling of many traditional budgets. How does this structured yet flexible plan connect back to that classic fable, the one we all learned as kids?
Ah, yes. It directly relates to that timeless fable of the ant and the grasshopper. Remember that one?
Of course, the hardworking ant and the carefree grasshopper.
Exactly. An optimal life, a truly fulfilling life, isn't about being solely the ant or solely the grasshopper. It's not about those extremes. It requires a healthy balance.
Finding the middle ground.
Finding the middle ground. It's about planning for survival. That's the saving and responsible financial management, like the ant. But also simultaneously allowing yourself to thrive, enjoying life experiences now, like the grasshopper. The conscious spending plan helps you strike that dynamic balance. You're consciously allocating funds to both your long-term security and your present-day enjoyment.
Avoiding the extremes of just hoarding money or just spending recklessly.
Precisely. And what's often most impactful, going back to awareness, is the simple act of regularly tracking every cent of your income and your outflows, just knowing where it goes.
Even if it feels tedious at first.
Even if it feels tedious, it builds this incredible awareness of your actual money behavior without judgment. You just see the patterns. And you might find, like one person mentioned in the source material did, that they were able to cut their food expenses by nearly 50% just by being mindful.
Wow, 50% on food.
Yeah. And then they consciously reallocated those savings to fund an amazing 3-week trip to Europe, an experience that brought them far more lasting joy and memories than that unconscious food spending ever could.
That is a fantastic, really tangible example of reallocating money, that life energy, to align with your values and actually live a richer life. Okay, so beyond the daily spending and the conscious plan, what's the next critical safety net? The thing everyone absolutely needs to build for those unexpected life events.
That would absolutely be establishing a robust emergency fund. This isn't just, advisable, it's crucial. It's non-negotiable for genuine financial stability and peace of mind.
How much are we talking?
The standard advice is to aim to save enough cash to cover 3 to 6 months of your essential living expenses. Ideally, if you can manage it, a full year's worth provides even more security.
3 to 6 months, maybe even a year. That sounds like a lot.
It can seem daunting, but building it up gradually makes it achievable. And having that financial cushion provides incredible freedom and flexibility. It really does.
Freedom in what way?
It empowers you to make significant life decisions without immediate financial pressure breathing down your neck. Like maybe leaving a job you truly dislike to pursue a new career path that aligns better with your values.
Okay, yeah, that's huge.
Or taking some time off work to care for a family member who needs you. Or just navigating an unexpected job loss without total panic, giving you time to find the right next opportunity, not just the first one that comes along.
It buys you breathing room. Options.
Options, exactly. Think of your emergency fund like the fire extinguisher you see in an office building. It's usually in a glass case, right?
Yeah. Break glass in case of emergency.
Exactly. It's there for true emergencies. It doesn't say, break glass if you feel a little stressed about a bill this month, or break glass because those shoes are on sale.
Good point. Resist the urge.
You have to resist the urge. The discipline to not dip into this fund for non-emergencies is absolutely key to its effectiveness and your long-term financial security. It should be easily accessible, sure, like in a high-yield savings account, but mentally, it needs to be cordoned off, reserved for true crises only.
Okay, an emergency fund is clearly non-negotiable. Got it. But for many people, before they can even seriously think about building up robust savings or investments, they feel completely weighed down by debt. Debt, especially that high-interest kind, can truly feel like this heavy chain around your neck, can't it?
Oh, absolutely. It's a huge psychological burden, besides the financial cost.
So what are the most effective practical strategies for breaking free from it? How do you get out from under that weight?
You're right. Debt, particularly high-interest credit card debt, is a massive impediment to financial freedom. It comes with what we often call a triple whammy.
A triple whammy. Okay, break that down for us.
First, you're often paying extremely high interest rates,
Right.
right? Sometimes 18%, 20%, even close to 30% annual percentage rate, or APR.
Yeah.
This makes it incredibly difficult to actually pay down the principal amount you originally borrowed, because so much of your monthly payment is just going straight to interest. You're running hard just to stay in the same place.
So that's whammy number one, the high cost. What's number two?
Number two is the impact on your credit score. Carrying high balances, especially on revolving credit like credit cards, negatively impacts your scores significantly. Your credit utilization ratio, basically how much debt you have compared to your total available credit accounts, for a big chunk, about 30% of your FICO score.
Right. Maxed out cards hurt your score.
They hurt it badly. And this can trap you in a downward spiral. It makes it harder to qualify for better interest rates in the future.
Which leads to whammy number three.
Exactly. A lower credit score limits your future access to credit, or makes it much more expensive when you do get approved. Getting a mortgage, a car loan, it all becomes harder, or costs you significantly more in interest over the long run. So the debt costs you money now and potentially more money later.
That's a really stark picture of that triple whammy. It's amazing how quickly just making minimum payments can trap you in that whole spiral. Can you give us a concrete example? Just how insidious are those minimum payments?
Oh, it's truly eye-opening when you see the numbers. Consider a seemingly modest purchase, maybe $1,100 on a credit card. Let's say it has an 18% APR, which isn't uncommon.
Okay, $1,100 at 18%.
If you only make the minimum payments each month And those minimums are often designed by the card companies to keep you paying interest for as long as physically possible.
Right, they're not designed to help you pay it off quickly.
Not at all. It could take a staggering 13 years to pay off that single $1,100 purchase.
13 years for $1,100.
13 years. Think about that in terms of your life energy. A significant portion of your effort, your work, dedicated to an expense from over a decade ago. You simply cannot become an automatic millionaire, as the books say, if you consistently run up credit card balances and only pay the minimum due.
Yeah.
All you'll really accomplish is making the credit card companies richer while you stay stuck, perpetually struggling.
Okay, that paints a very clear picture. Minimum payments are a trap. So what's the proactive strategy for breaking free? Do you have to stop saving completely and throw everything at the debt? Or is there a way to do both?
That's a great question, and it's not necessarily an either situation. Waiting potentially years until all debt is gone before you even start saving can be incredibly discouraging. It feels like you're making no progress on the future.
Yeah, you need some positive reinforcement too.
Exactly. So instead, you should adopt what we call the bury the past and jump to the future approach.
Okay, bury the past, jump to the future. I like it. What does it mean?
It means you begin both simultaneously. From your pay yourself first allocation, that money you're setting aside off the top, you dedicate a specific portion towards aggressive debt reduction, even while you're also starting to build your savings or emergency fund.
So tackling both at the same time?
Tackling both. This dual approach provides momentum. It actively tackles your past mistakes, the debt, while simultaneously building your future security, the savings. It gives you a psychological lift because you see progress happening on two important fronts.
That makes a lot of sense for staying motivated over the long haul. Okay, and is there a specific step-by-step method you recommend for tackling multiple debts, like several credit cards, maybe a personal loan, especially if consolidating them isn't really an option?
Yes, absolutely. There is a highly effective strategy known as the DOLP, that stands for the Debt Out of Existence Plan.
Debt Out of Existence Plan, DOLP. Got it.
Now, if you can, the easiest and often most efficient way to start is to try and consolidate all your high-interest debts into one account, maybe through a balance transfer to a 0% interest card or a lower-interest personal loan. That simplifies your payments and can save you money on interest.
Right, consolidation first if possible, but if not.
If consolidation isn't feasible, here's how the DOLP system works. You continue making the required minimum payments on all your credit cards or loans. Keep those current. But then you take an additional fixed amount, let's say $150 or $200, whatever extra you could realistically scrape together each month, and you apply that extra amount to only one specific debt.
Just one, not spread out.
Just one. Typically, you target the debt with the highest interest rate first. That's often called the debt avalanche method, and it saves you the most money mathematically.
Okay, highest interest rate gets the extra payment. Makes sense.
Then, once that first card or loan is completely paid off, boom, big win. You take the entire amount you were paying on that debt, that's its original minimum payment, plus the extra $150, $200 you were throwing at it, and you roll that full amount onto the next debt in line, usually the one with the next highest interest rate.
Ah, so you create a bigger payment for the next one, a snowball effect.
Exactly. It creates this powerful snowball effect. Each time you pay off a debt, the amount you're applying to the next one gets bigger and bigger. This provides incredible psychological wins as you knock out each debt one by one, and it significantly accelerates your path to becoming completely debt-free. Some people prefer tackling the smallest balance first, regardless of interest rate. That's the debt snowball, for quicker initial wins. Either method works if you stick to it.
That sounds like a really motivating system. Okay, so beyond credit cards, which often feel the most urgent because of those high rates, what about larger forms of debt, like a mortgage? How does owning a home factor into financial independence, and what are the strategies for managing that kind of significant debt effectively?
That's a really important piece of the puzzle. Owning your own home is often considered a significant cornerstone of financial security for many people, and it can absolutely be a key path towards becoming an automatic millionaire over the very long term as equity builds.
Right, building equity through home ownership.
However, it also comes with its own unique set of challenges and important considerations. The primary hurdle for many homeowners, especially early on, is that for the first decade, maybe even longer, of a typical 30-year mortgage, the vast majority of your monthly payment goes directly towards paying the interest.
Not towards the principal loan amount.
Very little goes towards the principal in those early years. You're building equity incredibly slowly. You're essentially working hard just to pay the bank their profit.
That's a pretty sobering thought, isn't it? Especially when you think about it in terms of that life energy concept again. So, is there a way to speed that up, to build equity faster and maybe reduce the total interest paid over the life of the loan?
Absolutely, there are ways. One highly effective strategy to accelerate your mortgage payoff is to make biweekly payments instead of the standard monthly ones.
Bi-weekly, so paying half the monthly payment every 2 weeks.
Exactly. Because there are 26 two-week periods in a year, doing this means you end up making the equivalent of 13 monthly payments per year instead of 12. You sneak in one extra payment annually without really feeling a huge pinch in your monthly budget.
Ah, clever. And that makes a big difference.
It makes a huge difference. This simple change can effectively shave anywhere between 5 and 10 years off your mortgage term. And think about all the interest you save over those eliminated years. Thousands, potentially tens of thousands of dollars.
Wow, just from that simple switch to bi-weekly.
Yeah. And just like with your savings and other automated payments, automation is crucial here too. Set it up so these biweekly payments are automatically deducted from your checking account. Make it effortless.
Set it and forget it again.
Set it and forget it. However, it's also really vital to understand that while real estate values generally appreciate over the long term, they are absolutely subject to significant fluctuations. We've all seen housing bubbles burst.
Definitely. It's not a guaranteed straight line up.
None at all. And there are potential pitfalls to be very aware of, like choosing a poor location, overpaying for the property in the first place, or maybe getting swayed by misleading sales tactics from agents who just want the commission.
So, buyer beware, as always.
Buyer beware. And a really critical consideration for homeowners, financially speaking, is to plan to stay in that home for at least 10 years, if possible.
10 years? Why is that time frame important?
Because it takes time to build meaningful equity, especially with those early interest-heavy payments. And more importantly, selling a house involves significant transaction costs. Think about real estate agent commissions, typically around 5–6% of the selling price, plus closing costs, moving expenses.
Right, those add up quickly.
They really do. Staying in the home for a longer period, like 10 years or more, helps you to amortize those large transaction fees over time. It allows the property value, hopefully, to appreciate enough to cover those costs and still leave you with a decent profit or equity gain. If you buy and sell too frequently, those fees can easily eat up any equity you've built or even leave you owing money.
Okay, this is great. We've covered mindset, conscious spending, emergency funds, strategies for tackling debt like credit cards and mortgages. So once we have a solid handle on those fundamentals, the next frontier, and this is the truly exciting part for many people looking to build long-term wealth, is investing. For someone completely new to this, maybe a little intimidated, what's the absolute most fundamental principle they need to grasp about investing before they even start?
Right. The single most fundamental principle, and it's one that gets surprisingly blurred and confused, especially by the financial industry itself, is understanding the clear, critical distinction between investing and speculation.
Investing versus speculation. Okay, how do we define those?
Benjamin Graham, who's often called the father of value investing, Warren Buffett was his student. He provided a really timeless definition. He said, essentially, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
Safety of principal and an adequate return based on analysis.
Got it. Anything that doesn't meet all three of those criteria, thorough analysis, safety of principal, adequate return, is by definition pure speculation. It's not investing.
So if something doesn't promise those things, it's basically a gamble, not a true investment.
It's essentially a gamble. You might get lucky, sure, but it's not based on a solid foundation of analysis and reasonable expectation. But here's the problem. Wall Street, and often the financial media that follows it, they have a strong tendency to blur this crucial line, don't they?
Oh, absolutely. They make everything sound like a hot investment opportunity. They definitely glamorize speculation.
They really do. And historically, this blurring of the lines consistently leads the public into making significant speculative mistakes, often resulting in substantial losses. We've seen this cycle play out over and over again throughout history. It's almost like a recurring financial fever.
Can you give some examples?
Oh, classic examples include the Dutch tulip mania back in the 1630s. Prices for ordinary tulip bulbs skyrocketed to absolutely absurd, irrational levels before the whole thing completely collapsed, causing a major economic depression in Holland.
Tulips.
Then there was the infamous South Sea bubble in England, about 300 years ago. It was basically a company with hardly any real business but promises of immense riches from trade with South America. It turned out to be effectively a massive con game that wiped out countless investors, including very prominent people like Sir Isaac Newton.
Even Newton got caught up.
Okay, that's
Yeah.
humbling.
It shows how powerful these speculative manias can be. More recently, think about the Nifty 50 stocks back in the 1970s. These were 50 supposedly can't-miss blue-chip growth stocks that everyone piled into, driving their valuations to ridiculously high levels before many of them crashed.
And the dot-com bubble, of course. And the dot-com bubble in the late 90s, early 2000s, that's a perfect example. All of these episodes show how excessive enthusiasm, often fueled by a fear of missing out FOMO, can lead to vastly inflated prices that are completely detached from the underlying value of the asset. Even fundamentally good companies become terrible investments when their stock prices get too rich relative to their actual earnings and future prospects.
So a key lesson is don't just chase hype or momentum.
Absolutely. A core rule to take away from these historical cautionary tales is never buy a stock just because it's gone up, or sell one just because it has gone down. You have to focus on the intrinsic value, the underlying business, based on sound analysis, not just the price chart or what everyone else seems to be doing. Avoid the herd mentality.
That's really powerful advice, especially hard to follow in today's fast-paced, constantly updating, news-driven market. It sounds like avoiding the herd and staying away from hype is absolutely critical. So, okay, for someone just starting out, maybe feeling a bit wary after hearing about all these speculative bubbles, what's a simpler, more reliable way to actually invest for long-term growth without falling into those common traps?
Right. What's truly fascinating here, and often completely counterintuitive to what the mainstream financial industry constantly promotes with its complex products and active strategies, is that for most investors, especially beginners, the simplest and most statistically effective strategy is to invest in low-cost index funds.
Index funds, okay. We hear that term a lot. What exactly are they and why are they so effective?
An index fund is basically a type of mutual fund or ETF, exchange-traded fund, that aims to simply track the performance of a specific market index, like the S&P 500, which represents 500 of the largest U.S. companies, or even the entire U.S. stock market or the total world stock market. Instead of trying to pick winning stocks, it just holds all the stocks in that index in their corresponding proportions.
So it's not trying to beat the market, just match it.
Exactly. It's accepting the market's return. And this approach is often referred to as a winner's game for the individual investor. While trying to beat the market through active management picking stocks, timing the market is generally, statistically speaking, a loser's game over the long run.
A loser's game. That really goes against so much of what we hear, doesn't it? Where everyone's looking for the next hot stock tip or the superstar fund manager who can consistently outperform. Why is active management considered a loser's game, and how does just owning the entire market make you a winner?
It really boils down to two main factors: cost and market efficiency. Think about the financial markets as basically a closed system. For every investor who wins by picking a stock that outperforms the average, another investor has to lose or underperform, right? It's a zero-sum game before costs.
Okay, winners and losers balance out before fees.
Right. But then you factor in all the costs associated with active trading.
Mm-hmm.
Higher management fees for those star managers, commissions paid to brokers, higher taxes due to frequent buying and selling. All these costs eat away significantly at returns. So, as a group, active investors inevitably underperform the market average after costs.
The costs drag the average down.
They drag the average way down. However, by owning the entire market through a broad, low-cost index fund, you are literally guaranteed to capture the market's average return, minus incredibly tiny costs. And here's the kicker. In this context, average doesn't mean mediocre.
Right, how so?
It means the combined performance of all the stocks in that index. And historically, over long periods, say 15, 20, 30 years, a simple market index fund has been shown to outperform somewhere between 82% and a staggering 99% of actively managed funds that were trying to beat it.
Wait, outperform up to 99% of the professionals trying to beat the market, just by matching the average.
It sounds crazy, but the data consistently bears it out. Accepting the average market return through indexing is actually a strategy for consistently excellent long-term performance, precisely because you avoid the high costs and the statistical difficulty of consistently picking winners. You're harnessing the power of the entire market, not just trying to find a needle in the haystack.
That is a truly surprising, almost shocking fact. An average strategy beats nearly all the experts. So those high costs of active management are really the main villain here. Can you break down those costs a bit more specifically for us so listeners know what to look out for?
Absolutely. Actively managed funds often come loaded with a whole cocktail of costs that significantly erode your returns over time, often more than people realize.
Mm.
First, you might have initial sales commissions, often called loads.
Loads, like a front-end load.
Exactly. A front-end load can be as high as 5.75% of your initial investment. That means if you invest $10,000, $575 is gone immediately, right off the top, just to pay the salesperson. Your investment starts $575 in the hole.
Wow, that's a big hit from day one.
It's huge. Then you have recurring annual costs. There's the management fee paid to the fund manager and their team. And there's the expense ratio, which covers the fund's operating costs, marketing, administration, etc. These can easily add up to 1%, 1.5%, or even more per year.
Every single year.
Every single year, whether the fund does well or poorly. And on top of that, there are internal trading costs. Because active funds buy and sell stocks frequently, they incur brokerage commissions and other transaction costs inside the fund, which aren't always explicitly stated, but still drag down performance.
So loads, management fees, expense ratios, trading costs, it adds up.
It adds up incredibly fast. If you combine, say, a 5.75% load plus a 1% annual management fee plus a 1.5% expense ratio, you've potentially given up 8.25% of your capital in the first year alone. And it's not just the money lost to fees, it's all the future growth that lost money could have generated through compounding over decades.
The opportunity cost.
The opportunity cost is massive. Now, compare that to a typical low-cost, broad market index fund. Its expense ratio might be 0.05% per year, or even less. The difference in long-term wealth accumulation is just astronomical. The principle is really clear and quite profound. Why pay for something, often with subpar results, when you can get the market return, which beats most professionals, for virtually free?
There's no point in paying for something if you can get it free. That sums it up pretty well. And you mentioned tax efficiency, too.
Yes, that's another significant advantage of index funds. Because they have very low turnover, meaning they don't buy and sell stocks frequently, they just hold the index funds. They tend to generate far fewer capital gains distributions each year compared to active funds.
Which means less tax to pay along the way.
Exactly. This allows more of your money to stay invested and compound tax-deferred or tax-efficiently over time, further boosting your long-term returns, especially in regular taxable brokerage accounts.
Okay, so low costs and tax efficiency are undeniably key advantages of indexing. What are some specific examples of these kinds of low-cost index funds that a beginner might look into based on the source material we're discussing?
The source material frequently points to Vanguard as a pioneer and leader in low-cost indexing, though other companies like Fidelity and Schwab also offer excellent low-cost options now. For broad U.S. stock market exposure, a classic recommendation is the Vanguard Total Stock Market Index Fund. Its mutual fund version often has the ticker symbol VTSAX.
VTSAX. Got it. Total U.S. stock market.
Right. For bonds, a similar core holding would be the Vanguard Total Bond Market Index Fund, ticker symbol VBTLX. This gives you broad exposure to the U.S. investment-grade bond market.
VBTLX for bonds. Okay. What about international exposure? Should investors look beyond the U.S.?
Absolutely. Diversifying internationally is generally considered a very good idea. For that, you could look at funds that track international stock markets, or even simpler, a total world stock fund that includes both the U.S. and international markets in one package. An example mentioned is the Vanguard Total World Stock ETF, ticker symbol VT.
VT for total world, so one fund for global stock diversification.
Exactly. The specific funds aren't as important as the underlying principle. Look for broadly diversified market index funds with the absolute lowest possible expense ratios you can find, regardless of the specific company offering them. Low cost is paramount.
Okay, so we're advocating for simple, low-cost, broadly diversified index funds for long-term growth. But investing, no matter how simple, always involves some level of risk, right?
Right.
How do we, as new investors especially, truly understand and manage that fundamental relationship between risk and potential return?
That's crucial. The fundamental inescapable law of finance is risk and reward are related. You generally cannot expect higher potential returns without accepting higher levels of risk. They go hand in hand.
No free lunch.
No free lunch, exactly. So it's absolutely critical to match your investment allocation, meaning how much you put into inherently riskier assets, like stocks, versus generally safer assets like bonds, to both your personal risk tolerance and perhaps even more importantly, your capacity for risk.
Okay, risk tolerance versus risk capacity. What's the difference?
Your risk tolerance is more psychological. It's about how comfortable you are emotionally with seeing your investments fluctuate in value. Can you sleep at night if the market drops 20%? That's tolerance. Your risk capacity, however, is more about your objective financial situation. How much risk can you actually afford to take? This depends on factors like your age, your time horizon until you need the money, the stability of your income, whether you have dependents, the size of your emergency fund, etc.
So someone younger with a stable job and a long time horizon has a higher capacity for risk than someone nearing retirement.
Generally, yes. They have more time to recover from potential downturns. So a basic guiding rule for asset allocation, often suggested for defensive or balanced investors, is to hold somewhere between 25% and 75% of your portfolio in common stocks, with the remaining portion, 75% down to 25%, in high-grade bonds.
So a range, not a fixed number.
A range. A classic starting point is a 50-50 split between stocks and bonds. Then you can adjust based on your personal situation and maybe even market levels. Some suggest maybe increasing your stock allocation slightly during prolonged bear markets when prices are low, and potentially reducing it when the market seems excessively high or dangerously high, though market timing is tricky.
Right. And is there a technique to help manage the risk of buying at the wrong time?
Yes, a very useful technique, especially for managing emotional reactions to market swings, is called dollar cost averaging.
Dollar cost averaging, how does that work?
It simply means investing a fixed amount of money at regular intervals, say every month or every payday, regardless of what the market is doing. When market prices are high, your fixed dollar amount buys fewer shares. When market prices are low, that same fixed dollar amount buys more shares.
Ah, so you automatically buy more when things are cheap and less when they're expensive.
Exactly. It forces you to buy low to some extent. It smooths out your average purchase price over time and removes the stress and guesswork of trying to perfectly time the market highs and lows, which is practically impossible anyway. It enforces discipline.
That definitely helps put risk into a much clearer, more manageable perspective.
Okay, what about the big picture then? There is just so much noise out there in the financial media, isn't there? Constant updates about market ups and downs, economic forecasts changing daily. How important is it to maintain a really long-term perspective amidst all that daily chatter? Oh, maintaining a long-term perspective is. It's arguably the single most powerful factor for success in investing, maybe even more important than picking the right funds. As long as you've chosen low-cost, diversified ones, it simply cannot be overstated.
Why is it so critical?
Because a crucial truth, one that history consistently reinforces again and again, is that the market always recovers.
Yeah.
Always.
Mm.
Despite countless major downturns, wars, recessions, pandemics, economic crises, political turmoil, long-term investors who simply stay the course, who don't panic and sell at the bottom, are consistently rewarded over time.
History shows resilience.
Incredible resilience. Just look at the long-term chart of almost any major market index. For example, the Dow Jones Industrial Average. Even after navigating countless disasters, it grew from around 616 in 1974 to over 17,800 by 2014. That's an annualized growth rate of about 11.9% with dividends reinvested.
Wow. Despite all the crashes and crises in between.
Despite everything, all you really would have had to do was buy, hold on tight, maybe rebalance occasionally, and just let it ride through those inevitable, often scary ups and downs. The real secret to compounding, the kind so powerfully demonstrated by legendary investors like Warren Buffett, isn't just his investment skill, although that's obviously immense.
It's the time.
It's the incredible, relentless power of time and longevity. He's been doing it consistently for decades. That's how true, substantial wealth accumulates. Time is your greatest ally in investing.
So trying to time the market, jumping in and out based on fear or greed, or constantly chasing the latest hot trend or sector, that's generally a losing battle for most people. It really seems like simplicity and that long-term stay-the-course view genuinely win out.
Precisely. You absolutely must train yourself to avoid performance chasing and market timing. The financial media thrives on promoting short-term narratives, right? The hot stocks of the moment, the winning fund managers who had one great year.
Yeah, they need something new to talk about every day.
Exactly. But study after study consistently shows that mutual funds with the best recent performance records very rarely continue to outperform in subsequent periods. Past performance is notoriously not predictive of future results for active managers. Chasing yesterday's winners almost guarantees you'll end up buying high and potentially selling low when the trend reverses.
Don't drive looking only in the rearview mirror.
That's a perfect analogy. And we see this temptation even with exciting new areas today. Take artificial intelligence, AI. It's undeniably a rapidly growing market projected to be worth trillions, and it's clearly revolutionizing countless industries. There are definitely significant investment opportunities there. But it's crucial to approach AI investments or any hot sector with the exact same principles we've been discussing. Thorough analysis, a long-term perspective, diversification, and avoiding the speculative pitfalls of just chasing the hype without truly understanding the underlying value and the considerable risks involved. Just like with the dot-com bubble, excessive hype, even around genuinely transformative technology, can lead to wildly inflated valuations that eventually come back down to earth, sometimes painfully. Don't abandon sound principles just because something seems exciting.
Sound advice. Stick to the plan. And you also mentioned something important earlier, a stark reality check about retirement.
Yes, it's vital to acknowledge this reality. For many people, retirement doesn't happen exactly when or how they planned it. It might come involuntarily, unexpected job loss, particularly later in a career, or the onset of illness or disability. These factors force over half of retirees out of the workforce earlier than they anticipated, according to recent studies.
Over half. That's a huge number.
It is, and it really underscores the critical need for robust, proactive, long-term financial planning. You need to build that resilience into your plan because life's journey can take truly unexpected turns, and you want to be financially prepared regardless of what happens or when. You might need that money sooner than you thought.
That's a powerful reminder that life doesn't always follow our neat timelines, making foresight and adaptability even more critical in our planning.
Okay, given that, and given that people are at different stages of life, should their investment approach change? Does it look different if you're just starting your career versus nearing retirement?
Yes, absolutely. Your investment strategy should generally align with your stage of life, which we can broadly categorize into two main phases, the wealth accumulation stage and the wealth preservation stage.
Accumulation and preservation. Okay, describe the accumulation stage. The wealth accumulation stage is typically when you are actively working, earning an income, and you have many years, maybe decades, until you actually need to start drawing money from your investments. During this stage, because you have that long time horizon to ride out market volatility, the recommendation is often to be more heavily weighted towards stocks, perhaps even 100% in stocks for younger investors.
100% stocks, like in a broad market index fund like VTSAX.
Exactly. The logic is that stocks have historically offered the highest long-term returns, and during this accumulation phase, you have the time to recover from inevitable market downturns. Maintaining a high savings rate during these years, combined with regular, consistent investing, like dollar-cost averaging, helps smooth out the market's wild ride and builds your capital most efficiently over time. You're focused purely on growth.
Okay, so focused on growth when you have time on your side. What happens when you transition into the next stage, the preservation stage? How does the strategy change then?
When you enter the wealth preservation stage, which is typically when you step away from your regular paycheck, maybe retire, and you start needing to live off your investments, the focus shifts. It shifts from maximizing growth to preserving the capital you've built and generating reliable income while still keeping up with inflation.
So less emphasis on aggressive growth, more on stability.
Generally, yes. At this stage, it becomes advisable to add bonds or increase your allocation to bonds in your portfolio. A fund like the Vanguard Total Bond Market Index Fund, VBTLX, would be a core holding here.
Why add bonds now? How do they help?
Just like the fresh cash you were regularly investing while you were working helps smooth out volatility, adding bonds now helps stabilize the overall portfolio. Bonds typically offer lower returns than stocks, but they also come with significantly lower volatility. They help smooth out the ride as you begin to draw down your capital, reducing the risk of selling stocks at a loss during a market downturn just when you need the money. They provide a more predictable stream of income as well.
So bonds act like a shock absorber for the portfolio in retirement.
That's a great way to put it, a shock absorber. Of course, in the real world, these stages aren't always perfectly distinct cutoffs. You might move between them, maybe work part-time in retirement, or have other income sources. The key is always to be adaptable. Regularly review your asset allocation and adjust it to match your current needs, your evolving risk tolerance, and your ongoing financial capacity throughout your life. #B. Essential accounts for your financial journey.
Okay, this is incredibly helpful. We've really dug into the crucial mindset shifts, the power of consistent saving, smart strategies for tackling debt, and understanding those simple, effective, long-term investing principles like index funds. Now, let's get truly practical again. What are the essential accounts people should actually be setting up to implement all these principles and, crucially, automate their financial journey as much as possible?
Right. Once you've embraced the mindset and understood the strategies, the critical next step is putting the infrastructure in place. Setting up the right financial accounts, and as you said, crucially, automating the flow of your money through them. This makes the whole process work almost on autopilot.
So where does the automation start?
It really begins with having your paycheck directly deposited into your primary checking account. That's step one for most people. From there, you want to automate basically all the important transfers and payments.
Like what specifically?
Send funds automatically on payday or the day after directly to your 401k if you have one at work. Set up automatic transfers to your Roth IRA or traditional IRA. Automate transfers into your dedicated savings accounts, and you can even have multiple savings accounts, nicknamed for specific goals like emergency fund, vacation fund, new car fund, or house down payment.
Okay, automating the saving and investing. What about bills?
Absolutely automate your bill payments whenever possible, especially recurring ones like mortgage, rent, utilities, insurance. And definitely automate your credit card payments ideally. Set it to pay the full statement balance each month to avoid interest charges completely.
So automating everything possible. It sounds like it makes that pay yourself first role truly effortless and just takes a huge amount of the mental load out of managing money day to day.
It really does. This set it and forget it system removes that decision-making friction we talked about. It makes your financial life so much easier, much more consistent, and absolutely ensure you're always paying yourself first before money disappears on other things. Automation is your superpower in personal finance.
Automation is your superpower. I love that. Okay, what about those essential retirement accounts that everyone talks about? Which ones should listeners really prioritize setting up?
For retirement savings, the 401k, or its equivalent like a 403b for nonprofit employees, or a TSP for government workers, is often the first and most powerful place to start, especially if your employer offers a matching contribution.
The employer match. That's key, right?
It is absolutely key. If your employer offers, say, a dollar-for-dollar match, up to 3% or 5% of your salary, you should prioritize contributing at least enough to get that full match. It is literally free money for your retirement.
Yeah.
It's an immediate 100% return on your contribution. You simply cannot beat that return anywhere else, risk-free.
Don't leave free money on the table.
Never leave free money on the table. And the beauty of 401ks is that the contributions are usually done via payroll deduction, so it's completely automatic from the start. You don't even see the money hit your checking account.
Perfect automation. Okay, so prioritize the 401k up to the match. What comes next?
Beyond the 401k match, individual retirement accounts, or IRAs, are vital tools. These come in two main flavors: the traditional IRA and the Roth IRA.
Traditional versus Roth. What's the main difference?
The main difference lies in how they're taxed. With a traditional IRA, your contributions may be tax deductible in the year you make them, depending on your income and whether you have a retirement plan at work. This reduces your current taxable income. However, your withdrawals in retirement are taxed as ordinary income.
Okay, tax break now, pay taxes later. What about the Roth?
The Roth IRA is the opposite. Your contributions are made with money you've already paid taxes on, so no upfront tax deduction. But the huge benefit is that all your investment growth and, crucially, all your qualified withdrawals in retirement are completely tax-free.
Tax-free growth and tax-free withdrawals. That sounds powerful.
It's incredibly powerful, especially if you expect to be in a higher tax bracket in retirement than you are now. It's important to understand the annual contribution limits for IRAs, which change periodically, and figure out which type makes more sense for your situation. But using one or both of these accounts can significantly boost your long-term wealth through that amazing tax advantage growth.
Got it. 401k with match, then IRAs. Are there any other specialized accounts that offer unique benefits people might not know about
Beyond these common retirement options?
Yes, there are a few others worth mentioning. If you are eligible, meaning you're covered by a high-deductible health insurance plan, HDHP, then a health savings account, or HSA, is an absolutely phenomenal savings tool. It offers truly unique triple tax benefits.
Triple tax benefits. Okay, what are they?
First, your contributions are tax deductible, similar to a traditional IRA. And if you contribute via payroll deduction through your employer, those contributions often avoid Social Security and Medicare taxes too, which is an extra bonus. Second, the money you invest within the HSA grows completely tax-free, just like a Roth. And third, if you withdraw the money for qualified medical expenses now or decades from now in retirement, those withdrawals are also completely tax-free.
Wow. Tax deduction going in, tax-free growth, and tax-free withdrawals for medical costs. That's amazing. It's unbeatable. And unlike flexible spending accounts, FSAs, the money in an HSA rolls over year after year if you don't spend it. It doesn't expire. So many people use HSAs as a stealth retirement savings vehicle, letting it grow tax-free for decades, and then using it to cover healthcare costs in retirement, tax-free. If you're eligible for an HSA, it's definitely something to look into seriously.
Good tip. HSA for those eligible. What about saving for kids' education?
For saving for future education expenses like college or trade school, 529 plans are generally considered the best tool. They offer tax-advantaged growth specifically for qualified education expenses for your children, grandchildren, or even yourself. Contributions might even be deductible on your state taxes, depending on where you live.
Okay, 529s for education. Anything else?
There are also UTMA or UGMA accounts, Uniform Transfer Gifts to Minors Act accounts. These are often used for gifts and money held in a child's name. However, they come with different implications regarding who controls the money, the child gains control at the age of majority, and how they might impact financial aid eligibility for college, so they need a bit more careful consideration compared to 529s.
That's a really comprehensive list of accounts covering different goals: retirement, health, education. What about later in life, specifically regarding withdrawals from those retirement accounts like 401ks and traditional IRAs? Are there any important rules people absolutely need to be aware of?
Yes, this is a really important point for retirees or those approaching retirement. It relates to something called required minimum distributions, or RMDs.
RMDs. Okay, what are those?
Once you reach a certain age, currently age 73, though it's been changing, the IRS requires you to start taking mandatory withdrawals from most of your tax-deferred retirement accounts. This includes traditional 401ks, traditional IRAs, 403bs, etc. Roth IRAs are generally exempt from RMDs for the original owner.
So the government wants you to start taking the money out and paying taxes on it.
Exactly. They give you a tax break for decades. Now they want their share. And failing to take these required distributions or not taking out the correct amount comes with a very steep penalty. It used to be 50% of the shortfall, though it's recently been reduced to 25% or even 10% if corrected promptly. Still, it's a significant penalty you absolutely want to avoid.
25% penalty. Ouch. Yeah, definitely want to avoid that. Is it complicated to figure out?
It can seem a bit complicated, as the amount is based on your account balance and your life expectancy according to IRS tables. But the good news is that most financial institutions like Vanguard, Fidelity, Schwab, etc. can help you automate this process.
Automation again?
Automation to the rescue. They can calculate the correct RMD amount you need to withdraw each year and can automatically transfer it to your bank account or another investment account on schedule. This ensures you comply with the IRS rules and avoid those hefty penalties. It's another aspect of financial planning where setting things up correctly up front brings tremendous peace of mind later on.
This has been just incredibly insightful, really breaking down these often complex topics into clear, actionable steps. Hashtag tag outro. We have definitely covered a lot of ground today, haven't we? From really shifting your whole mindset about money and wealth,
To implementing those practical strategies for conscious spending, consistent saving, tackling debt effectively.
and starting your investment journey with confidence, using simple, proven principles like low-cost index funds.
Yeah, the core message, hopefully, is that financial independence isn't some far-off dream reserved only for the super lucky or the ultra-wealthy.
Right. It's genuinely an achievable goal for most people through consistent, informed action and a clear understanding of these fundamental basics.
Absolutely. And as you embark on your own financial journey, whether you're just starting out today or maybe looking to refine or optimize the plans you already have in place, here's maybe a final thought to consider.
Okay, leave us with something provocative.
The ultimate legacy you create, financially speaking, isn't just measured by the final number, the amount of money you accumulate. It's also measured by the freedom you gain along the way, the rich experiences that money enables you to have, the choices you empower yourself and your family to make, and perhaps most importantly, the financial wisdom and confidence you're able to pass on to future generations. So maybe ask yourself, how will your financial path, the choices you make starting today, empower your life's deepest purpose?
That's a fantastic question to ponder. How will your financial path empower your life's purpose? Thank you for that. And if you, our listeners, found this book talk insightful and you want to continue demystifying the often confusing world of finance.
And be sure to subscribe to our channel.
Exactly. Subscribe for more discussions, more book talks, and deep dives into finance and related topics. Thanks for tuning in.